Hello, welcome everybody to today's presentation on 1031 Exchange Basics. My name is Jeff Stechmann. I'm the Business Development Manager for Asset Exchange Company. Before we kind of dive in today, just want to give everybody some information on how we're going to handle today's webinar. Don't feel like you have to write every single thing down. You will receive a link to today's recording. We have both the audio and the video of today's presentation. If you want to refer back to any of the topics that we cover, feel free. And a lot of what we're going to talk about today, I have in PDF form, just various topics. I'm going to email those PDFs out to everyone that's attending today. So don't feel like you have to write every single thing down. You'll get the you'll get the PDFs, and you'll get the link to today's recording. The PDFs are great, especially if you're a realtor and you have clients that possibly have 1031 exchange needs. It'll be really something easy to be able to send out to them. And but again, I'll send that out to everybody. And as far as how we're going to handle today's presentations for questions. I'm going to open the floor up to questions at the very end of the presentation, because I found in a lot of cases, if you do have a question, most often it's going to be answered in an upcoming slide. But again, if for some reason we don't cover it, then feel free at the end to ask questions. There's a box on the right-hand side that says questions. Right there is where you would type it in. And again, I'll remind everybody at the very end. Looks like we had a few people join a few minutes late. So again, my name is Jeff Stechmann, Business Development Manager for Asset Exchange Company. Kind of give you guys some information about myself. I've actually been in the business. This is my 26th year. I did a lot on the title side of the business to get my start. I'm originally from New Orleans, so if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head, but I'm actually based out of Tampa, Florida. I've lived in Florida for 22 out of those 26 years. I've seen just about everything there is. I've done just about everything there is to do on the title side and of the business. That's how I got my start. As long as I've been doing this, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times. So hopefully you never have to see those bad times again. And anybody that's been doing it as long as I have, hey, we must be doing something right? Because after doing it all these years, we're still in the business. So let's dive right in. So let me give you some information about the company. So again, we're Asset Exchange Company, and we've actually been in business since 2006. And over the course of our existence, we've done about 35,000 1031 exchanges. It's all that we do. We don't provide any other type of services other than 1031 exchanges. Like we don't provide any type of closing services, escrow services, any type of financial services. In the business, we're known as a qualified intermediary. Now, QI for short. Now, other terms you may hear people refer to is an accommodator. Another term is a facilitator, or just simply an intermediary. But at least in our neck of the woods here in Florida or throughout the eastern United States, people just call us QIs. And our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. We hold the proceeds from that sale on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they would lose their ability to do a 1031 exchange. And we're going to talk about that in more detail in some upcoming slides. But a word of caution, on a national level, or at least a federal level, there actually is no federal agency that oversees what we do. So, exactly what does that mean, right? Well, what that means is anybody out there can be a QI, can be a qualified intermediary. There's no type of requirement you have to have any type of insurance. There's no type of requirements you have to have any type of bond. There's no guidelines on the type of financial institutions where you hold the proceeds, the type of funds you hold the proceeds in. It's a really scary thought when you really sit down and think about it. So if anybody on the line today is currently involved with a 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. Great news when we deal with us is we're actually based out of California. Our home office is in San Francisco. And because we're based out of California, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in. We're subject to audit by that Franchise Tax Board, which is great for anybody that deals with us in California, right? But anything that we do nationwide, because we handle 1031 exchanges throughout the entire country, multiple states. That Franchise Tax Board has oversight in anything that we do, any of the files that we work on, because as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on, not just California property, but anything that we do. So you do have some assurances that at least we have a state agency that's overseeing all of our practices. We've never failed any type of audit with them either. Now, as far as our ownership goes, we're actually owned by two gentlemen. They have been in the 1031 exchange business specifically for like 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on tax law and real estate, that type of thing. The whole reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we would actually provide free audit support. Now, we would work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney, Adam Skarsgård. So another reason to deal with us, another great reason to deal with us, right? Now, let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has actually been around for, starting this year, 100 years. All right. It started back in the 20s with farmers. And, it was pretty simple back in those days, the way exchanging worked. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm and he wanted my farm. So all we did is just swap farms. And it was really that simple back in those days. But our modern day exchanges, kind of the format that we follow today, well, that started back in 1979. And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker, he lived in California, and he owned all this land in California with timber on it. And what he did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, they gave him what was referred to as exchange credits. And what Mrs. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. So if anybody on the line today has ever heard of the term a Starker exchange, well, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs that have been in the business for, 30, 40 years. They still refer to a 1031 exchange as a Starker exchange. So again, you may hear that occasionally pop up, but that's where it comes from, T.J. Starker's last name. Now, when we talk about 1031 tax-deferred exchange, well, the name is actually derived from Internal Revenue Code, Section 1031. All right, and the code states this: no gain or loss shall be recognized on exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Now, I know that's kind of a mouthful, right? Well, where the code states that property held for productive use in a trade or business, so you can do a 1031 exchange on any type of real property that you use in your trade or business. All right, I'll give you guys an example. we did an exchange for a gentleman. He owned a daycare center, right? So he was using that real property for his business. So he did a 1031 exchange, and when he sold the property, the daycare center, deferred his taxes. We're going to talk about that in just a minute. And in his case, what did he go out and buy as a replacement property? We actually went out and bought another daycare center because why? He was going to use that property for his business. All right. So again, any type of real property that you use in your trade or business, you can sell that in a 1031 exchange, and you can replace it with any other type of real property that you use in your trade or business. All right. Now, the next part of the code where it says for investment. So for investment could be something as simple as, let's say you own a single family residential home. You hold that for investment. Well, how do you hold it for investment? What's a rental property, right? So you can take that rental property, you can sell that rental property in a 1031 exchange, and then what can you buy as your replacement? Well, that's the next part of the code where it says Litecoin Property. So what exactly is Litecoin Property? Litecoin Property is any type of real property that you use in your trade or business or that you hold for investment. You can sell that in a 1031 exchange, and you can replace it with any other type of Litecoin property, which is any type of real property that you use in your trade or business or that you hold for investment. All right. So just because you own that single family residential home, all right, you have to hold for investment, right, that rental property. When you sell that in a 1031 exchange, you don't have to replace it with another single family. Now, you can if you want, by all means, but you could even replace it with a duplex, a fourplex, vacant land, a condo, a townhome. Hey, you want to replace it with a commercial strip shopping center, a commercial warehouse. It does not matter. All right. It doesn't matter if it's residential or commercial or residential. None of that matters. What matters is as long as what you're selling, using that property in your trade or business, all right, or you're holding it for investment, and you have to replace it with Litecoin Property, which is any type of real property that you use in your trade or business or that you hold for investment. All right. Again, it doesn't matter if it's residential or commercial to residential, none of that matters, right? And those properties can be located anywhere in the United States, including Guam or the U.S. Virgin Islands. All right. Now, property in Puerto Rico is excluded from 1031 exchange. I get that question every now and then. I think property in Puerto Rico is excluded because Puerto Rico is under a different tax structure than we are here in the States, and I think that's why Puerto Rico is excluded. Property in Puerto Rico is excluded from 1031 exchange. Okay, if you've ever heard of the term a Litecoin exchange, that's where it comes from. It comes from that part of the code that talks about Litecoin property. Here in Florida, the standard real estate contract that realtors use here in Florida, it's referred to as the FAR bar. When that FAR bar contract, in Section 18, Item N, there's standard language in there for 1031 exchange. It actually refers to a 1031 exchange as a Litecoin exchange. So again, you will see that every now and then, but again, that's where it comes from, the part of the code that talks about Litecoin property. All right. Now, what are current tax rates? Well, typically when you sell real property, all right, if you have any gain in the property, you're going to be subject to capital gains taxes. Now, capital gains taxes right now are either 15% or 20%. Now, the 15% historically was applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of greater than $400,000 a year. That's where you're at the 15% capital gains tax rates. Now, the 20% capital gains tax rates historically were applied if you were single and you had income of greater than $400,000, or if you were married and you had income of greater than $450,000. Well, that's where you're at the 20% capital gains tax rate. Now, the reason I say historic, because the income rates levels, I think they have risen just a bit with the last tax reform bill that they did a few years ago. But any way you look at it, you're still going to be looking at either 15 or 20% capital gains tax rates. Now, on top of that, you also are going to be subject to what they refer to as depreciation recapture tax. Now, that's an additional 25% tax. Now, how does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in the property, the total amount of depreciation that you've claimed for the entire lifetime that you've owned the property. When you go to sell that property, they're going to hit you with a 25% depreciation recapture tax on the entire amount of depreciation you've claimed for, again, for the lifetime that you've owned it. All right. Now, on top of that, you may also be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, how does that work, right? Or what is that all about? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act, right? So when you do a 1031 exchange, you can defer having to pay any of these taxes. All right, now what am I not listing up on the slide? Well, I'm not listing anything to do with state income taxes. Now, for those of y'all on the call that are located here in Florida or in a state that, like Florida, that doesn't have state income taxes, well, we don't need to worry about that, and y'all don't need to worry about that either, all right, because there's no state income taxes. But if you live in a state, or even if you're selling property in a state that has state income taxes, you would also be subject to state income taxes. Now, when you do a 1031 exchange, you can also get out of having to pay the state income taxes. Now, every state has their own way of you going through some type of process or completing some type of form in order for you to get out of having to pay those state income taxes. I'll give you guys a couple examples. We did an exchange for a gentleman. Now, he was a Florida resident, okay, but he owned some property, an investment property in California. Now, California has state income taxes. I think they can be as high as like 11 or 12%. It's kind of like a tiered level. Now, because he was selling property that was located in California, even though he wasn't a California resident, he was a resident of Florida. Guess what? California still wanted their state income taxes. But good news for him is he was doing a 1031 exchange, so he was able to get out of it. Now, their process is you have to complete this form, all right? He had to complete the form, send it into the state of California to get out of having to pay the state income taxes. Now, it's my understanding that he's got to complete that form every year thereafter. The year he doesn't complete the form, guess what? They come after him for the taxes. All right. Now, we did another exchange for a lady. Now, she was another Florida resident. Okay. Now, she was selling property. I think it was Maryland. Well, Maryland has state income taxes. What they made her do in order to get out of having to pay them, because she was doing a 1031 exchange with us, she had to complete the state of Maryland form. I think she had to complete it. We had to sign off on it. She had to get it to the state of Maryland 21 days prior to closing. Okay, so that's their process. Again, every state kind of has their own way of you filling out some type of form, going through some type of process in order to get out of having to pay those state income taxes. All right, but the good news is it can be done. All right. For those of y'all that are realtors on the line, all right, think about it. If that's your client, all right, if they're looking at the federal taxes, which we have in the slide, okay, doing a 1031 exchange is definitely going to benefit them, right? Now, if it's your client and they actually live in a state that has state income taxes, well, it's even more worth their while to do a 1031, right? Because they're going to save on all the federal taxes, paying that tax bill. They're also going to save on the state income taxes as well. So it's even more worth their while. So, here in Florida, we have so many people that retire and they move to Florida. And sometimes what happens with realtors in Florida is that they may not even be working on the listing side of it, of the transaction, right? They might be just helping a client find some replacement property here in Florida. All right, now maybe that client, say they live in New York. Okay, now New York has state income taxes, right? It's my understanding they have state income taxes, they have county taxes, city taxes. Again, when you do a 1031 exchange, you can get out of having to pay those taxes, right? Well, if they're selling investment property in New York and they're looking to buy some replacement property here in Florida, an investment property, right, and you're their realtor, right, and they're not talking about doing a 1031 exchange, it's a perfect opportunity to bring it up, right? Because, hey, if you can help them save on the federal and also save on the state taxes as well, Well, what is that going to do for them? Well, it's going to help them save the taxes, obviously, but now they just have that much more to use to go out and buy a better property. Hopefully, it's going to be a higher dollar property, right? And what is that going to do for you as a realtor? Well, it's going to make you look great to the client because you saved them with having to pay all the taxes. And if they can buy a higher dollar property, well, hopefully you just increase your commissions, right? Because now they can get that higher dollar property, and hopefully it's going to be a higher income producing property for them as well. All right, so it's win-win all around. The client wins, and you win as well. All right, now let's talk a little bit about the next question: intent to hold for investment. I get this question all the time. People say, "Well, Jeff, how long do I need to hold on to a property for it to be considered an investment property?" And the honest answer is, I don't know, right? Because there's nowhere in the code that states how long you need to hold on to a property for it to be considered an investment. All right, it just states that you need to use the property in your trade or business or hold it for investment. All right, now if you ask some CPAs, they'll tell you good rule of thumb is to hold on to it for at least 12 months, for a year. And if you just think about the logic behind that for a minute, right? If I purchased a property today, an investment property today, right? Well, I'm going to claim it on my 2021 taxes, right? Now I'm holding it for a year, for 12 months. I'm also going to claim it on my 2022 taxes, right? So I'm going to be reporting that property as an investment property over 2 tax filing years, right? Any income that's coming in off of rent, any expenses that I'm paying out, all right, that's going to be reported over 2 tax filing years. So is that a good rule of thumb? Well, the answer is maybe. All right. Now, some other CPAs will tell you, well, no, really a good rule of thumb is to really hold on to it for 2 years or 24 months. Now, one of the reasons behind that, we're going to talk about it in the very next slide. Back in 2008, the IRS came out with guidelines regarding vacation homes, right? And in those guidelines for vacation homes, the IRS stated for a vacation home to be considered an investment property, you must own that property for a minimum of 2 years or 24 months, right? So some CPAs pick up on that and they say, well, for vacation homes, the IRS is giving us guidelines stating that for that vacation home to be considered an investment property, you must hold on to it for 2 years or 24 months. Therefore, any type of investment property, you really need to hold on to it for at least 2 years or 24 months to be considered an investment. But, it's not so much about how long you own the property. It's more so about your intent. All right. And your intent could be something like this. Did you advertise the property for rent? Did you advertise it for fair market value rent? Right now, fair market value rent is, let's say, $1,500 a month, and you're advertising it for $5,000 a month. You know what? The IRS is probably going to have an issue with that. All right. If you get audited and the IRS comes in and says, hey, prove to us you held that property for investment, you're going to have to be able to back it up. All right. Now, I'll list one particular court case on the slide. It's referred to as Resnick versus the commissioner. Now, the circumstances of that case was you had a husband and wife, all right? They owned a single-family residential home. Now, that was their primary home, their primary residence. They also owned another single-family residential home that was an investment property, a rental property, right? So they sell the rental property in a 1031 exchange. The replacement property that they buy is another single-family residential home. That was going to be the new investment property, right? Now, during the 6-month period after they did their 1031 exchange, during that 6 months, they ran a classified ad in the town newspaper that they lived in, advertising that property, the new investment property, for rent, fair market value, right? Now, they even showed it to 2 potential renters during that 6-month period. But for whatever reason, they could never get the thing rented out. Well, what else happened during that 6-month period is one of them loses their job, right? So they had a mortgage on their primary home. They also had a mortgage on that new replacement investment property. But what? It wasn't being rented out, right? Now, after 8 months had passed, what they decided to do was they decided to sell their primary home and they moved into the investment property. All right. In that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? where their circumstances changed, right? And they were forced to do something. So again, it's not so much about how long you own the property, it's more so about your intent, right? And again, if you get audited, you're going to have to be able to back it up. All right. Now, let's talk a little bit about vacation homes. Hey, I always like to talk about vacation homes because, especially here in Florida, we have so many people, again, that want to move here. They want to have a vacation home. You know, it seems like everybody in Florida either has a vacation home or wants a vacation home. So, how does that vacation home qualify as an investment property? Well, this is actually referred to as Revenue Procedure 2008-16. Now, the first guideline I've already given you guys, all right, you must own the property for at least 2 years or 24 months. All right, now, for every 12-month period of ownership, all right, you must rent the property out for a minimum of 14 days at fair market value. All right, now, you can use it for some personal use, right? For every 12-month period of ownership, you can actually use it for 14 days personal use or 10% of the total time that it was rented during that 12-month period. So let's just say during that 12-month period, let's say you rented it out for 200 days, right? So 10% of 200 would be what? Would be 20 days, right? So you could use it for 20 days personal use instead of the 14. Now, if that property meets those guidelines, hey, it qualifies as an investment property, and you can use it in a 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified, right? In that case, I would recommend to the client, I'd say, look, talk to your CPA, right? And if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, by all means, use it in the 1031 exchange, all right? We're always going to recommend to people, talk to your CPA, right? Because your CPA is going to have way more information about your tax situation than I ever would, right? That I would even ever want to know, all right? If the CPA comes back and says, yeah, I think we could justify that property as being an investment property. And you know what? Hey, we move forward with it, use it in the 1031 exchange, right? Vacation homes. This is one of the slides, one of the PDFs I'm going to send you guys. Remember I told you all in the very beginning, some of the topics we're going to talk about today I have in PDF form. This is one of them. So I'm going to get that out to you guys, after today's presentation. Okay. So let's talk a little bit about the 1031 exchange guidelines, all right? I'm going to recap what the property qualifications are, all right? What are the tax deferral requirements? There's some timelines everybody needs to be aware of, okay? And there's also some identification rules. So, again, what type of property can you do a 1031 exchange on? Any type of property that you use in your trade or business or you hold for investment, all right? You can sell that in a 1031 exchange, and you can replace it with what kind of property? Any type of like-kind property, which is any type of real property you use in your trade or business or that you hold for investment, all right? And where can those properties be located? Anywhere in the United States, including Guam or the U.S. Virgin Islands, right? Again, property in Puerto Rico is not included in that number. All right. Now, what type of top property is excluded from 1031 exchange? All right. Well, your primary residence. Okay, you can't do a 1031 exchange on your primary home. All right. On your primary, you may qualify for what they refer to as a Section 121. And briefly, the way the 121 works is you have to have lived in the property for at least 2 years as your primary. Okay. When you go to sell the property, if you're single and you have gain in the property, if you're single, the first $250,000 of any gain is tax exempt, and if you're married, the first $500,000 of any gain is tax exempt. All right, that's referred to as a Section 121. Now, you don't need anybody like me to help you with the 121. That's just something that you claim on your tax return in the year that you sell your primary home. Okay. But primary residences are excluded from 1031 exchange. You can't do a 1031 exchange on your primary. All right. Again, you may qualify for that Section 121. Now, property held for sale is excluded from 1031 exchange. Now, what exactly is that, right? I'll give you guys an example. Let's say I'm a builder. Okay. Like here in Florida, we have a lot of these national home builders like Pulte Homes, Lennar Homes, KB Homes, all right? Now, Pulte Homes, they're a publicly traded company. They're one of the largest single-family residential home builders in the entire country. right? Now they build in multiple states, new construction in multiple states, right? Let's just say I'm Pulte. Now, the properties that Pulte builds, right? When those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and they're not holding them for investment, they can't do 1031 exchanges on those types of properties, all right? So property held for sale is excluded from 1031 exchange, all right? What are the type of property? Well, dealer property is excluded from 1031 exchange. Now, what exactly is dealer property? Well, dealer property may be somebody that we refer to as a flipper. You know, let's say, I don't know, they buy a property, it takes them maybe 2 or 3 months, they fix it up, and then what do they do with it? Well, they turn around and sell it. Well, you can't do a 1031 exchange on that type of property, all right? Because they're holding that property for sale. All right, that's like the business that they're in, right? That's like their inventory. They fix the property up, they turn around and sell it. All right, you cannot do a 1031 exchange on that type of property. All right, because again, they're holding it for sale. Now, here's an example of something that may work with a flipper. Let's say they buy a property. I don't know, 2 or 3 months goes by, and then when it's finished, instead of selling it, they go to their realtor and they say, "Hey, can you put this in the MLS system, showing it for rent? Right? Let's put it in there for fair market value rent." That's a little bit different, right? Because now all of a sudden they're showing their intent that they're going to be holding it for investment and not for sale, right? Hey, who knows? Maybe they even show it to a potential renter. They show it to that potential renter. They run some type of credit report on the potential renter. Hey, the potential renter has horrible credit, and they decide not even to rent their property to them, okay? If that flipper gets audited and the IRS comes in and says, "Hey, prove to us you held that property for investment and not for sale," they're going to have to be able to back it up. All right, in the example I just gave you guys, hey, there's a good chance they could back it up, right? Because they could say, "Look, here's an email that I sent to my realtor asking them to put it in the MLS system at fair market value rent." Right? Here's the day it went into the MLS system showing it for fair market value rent. Here's the listing showing it from MLS showing it for fair market value rent. Hey, here's the day I showed it to that potential renter. Here's the credit report I ran on that potential renter. All of that type of stuff is going to be their backup, right? It's going to be their proof, their trail of breadcrumbs, right? That they held that property for investment and not for sale, all right? But again, if they just fix the property up, you know, I don't know, 2 or 3 months goes by, whatever it may be, and they turn around and sell it, can't do a 1031 exchange on it, okay? Foreign property is excluded from 1031 exchange. Now, this might be pretty obvious, but let's say I couldn't sell a property here in Florida, an investment property, do a 1031 exchange, and then try to buy replacement property somewhere in Canada or Mexico or somewhere in Europe, okay? It has to be what? It has to be property that's domestically located, right? Anywhere in the United States, including Guam or the U.S. Virgin Islands, all right? So foreign property is excluded from 1031 exchange. All right, now, guideline number 2, what are the tax deferral requirements? So in order to get a full deferral, to defer your taxes 100%, okay, rule number 1 is you must reinvest all of the net proceeds of property of equal or greater value. Now, what are the net proceeds? The net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing. All right. Now, we're the qualified intermediary. We're going to hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. All right. So they can't close today and then call me tomorrow and say, "Hey, Jeff, I want to do a 1031 exchange." At that point, it's too late. All right. They couldn't even close today and call me from the parking lot at the escrow company, title company, attorney's office who just did the closing, okay? They've lost their ability to do a 1031 exchange because their funds may be sitting in that company's escrow account. They may be waiting to wire the funds out to them. At that point, they have what's referred to as constructive receipt, right? They have a legal right to the funds. They've lost their ability to do a 1031 exchange, right? So we have to get involved prior to closing, or prior to them walking out the door, basically, all right? We're going to hold the proceeds on their behalf. Back to the rule. What do they need to do? They need to take that entire amount, and they have to go out and they have to buy a replacement property, or it can even be a combination of properties where the purchase price or the combined purchase prices are either equal to or greater than whatever the sales price was on the property that they sold, the relinquished property. All right, that's rule number one. Rule number two is you must acquire an equal amount of greater debt. Now, what exactly does that mean, right? Well, the debt, if you have a loan that you're paying off, right, you're required to obtain a loan of at least that amount or greater in the purchase of any replacement property or properties. Now, that loan can actually have an exception, okay? If you have cash that you can add to the purchase of your replacement property, you can offset having to acquire any debt or any additional debt, right? So again, reinvest all the net proceeds of property of equal or greater value and acquire an equal amount of greater debt, right? And we have to hold the proceeds from the sale. If they close today, it's too late. All right. Once they close, that's it. Once they have actual receipt or they even have constructive receipt of the funds, they've lost their ability to do a 1031 exchange. Okay. Now, guideline number three. There's some timelines everybody needs to be aware of. All right. So for when you close, all right, when you close escrow, you'll have 180 calendar days to purchase any replacement property or properties. And that's calendar days. That's holidays. That's weekends. Okay. Monday's Martin Luther King Day. Doesn't matter. The clock's still ticking. All right. In Florida, anywhere throughout the eastern United States or the Gulf Coast, from June 1st to November 30th is hurricane season, right? Hey, if you're getting hit with a hurricane and everything's shutting down for a day or two or a week, whatever it may be, it does not matter. Okay, the clock is still going to be ticking. All right, so you have a total of 180 calendar days to purchase any replacement property or properties. Now, the first 45 days of the 180, that's referred to as the identification period. What exactly does that mean, right? Well, the identification period is you must identify any potential property or properties that you want to buy. All right, that's something else that we're going to assist with, right? We're going to provide a form to the client. It's called the identification ID letter. On that form, there's going to be some blank lines, all right? And it's going to have to be specific to a property address or addresses. They'll have to complete it, sign off on it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property. They do it to us, the qualified intermediary, right? None of those properties even have to be under contract. You just have to identify any potential property or properties that you want to buy. But here's the thing. Let's say you find the perfect property on day 46, okay? At that point, it's too late, all right? So whatever you put on that form, you're going to have to make sure you're going to be able to buy at least one of those properties. If for some reason you're unable to purchase any of those properties by midnight of the 180th day, you're going to be paying all your taxes. All right. If you don't identify any properties by midnight of the 45th day, you're going to be paying all your taxes. There is no exceptions after midnight of the 45th day. All right. If one of the properties burns down to the ground, one of them gets sold, it does not matter. There's no going back after midnight of the 45th day saying, hey, I want to identify that property because it just sold. It doesn't matter. All right. So very strict. 45 days to identify. You have a total of 180 calendar days to purchase your replacement property or properties. All right. Now, guideline number 4. There's some rules everybody needs to be aware of. All right, rules as far as identification goes. Now, there's 3 different rules. All right, I'm going to read each one of the rules to you. And if you don't quite understand them when I read them to you, don't worry about it, because for each one of the rules, I'm going to give you examples of how the numbers work. All right, and once I show you that, hopefully it's going to click for you. All right, now, the most popular rule that we see, probably 90 to 95% of all the exchanges that we do fall under this first rule. All right, it's referred to as the 3 property rule. All right, and the 3 property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. Now, what exactly does that mean? Well, fair market value, that's the purchase price or purchase prices. All right, so if you identify 3 properties or less, the purchase prices of any of those properties can be any dollar amount. It does not matter, right? As long as you identify 3 properties or less, the purchase prices can be any dollar amount. Now, if you want to identify more than 3 properties, not a problem, all right? But it's going to throw you into the next rule, all right? It's referred to as the 200% rule. And what that states is you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, what that means is if you identify more than 3 properties, okay, the combined purchase prices of all those properties that you've identified cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, the relinquished property. Okay. Now, if you want to exceed the 3 property rule and you also want to exceed the 200% rule, well, you can do that. But you're going to fall into the next rule, right? It's referred to as the 95% rule. Now, it's very rare that we even see this rule get enacted, all right? It's not talked about that often. We have some pre-printed literature that sits in real estate offices, title companies, attorneys' offices. It's not even listed in there because it's so rare. But I want everybody on the line today to realize it does exist. All right, it doesn't make a lot of sense the way it's written, but remember, everybody, hey, this is the IRS, and I don't know, sometimes this stuff just doesn't make sense. All right, because it reads like this: you can identify over 3 properties, and you can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud. Let me show you all the examples of how the numbers work, especially with this 95% rule, and then hopefully it all makes sense to you. Okay, once I show you the numbers. So here's the 3 property rule. Again, 3 property rule states that you can identify up to 3 properties without regard to the fair market value. So the purchase prices can be any dollar amount. All right, so here's how it works. We sell for $1 million. Now, we go out and we identify 3 properties, okay, because we've identified 3. We're in the 3 property rule. Now, let's just say we're going to be buying each one of those properties for $1 million each. So we've identified how much in property? $3 million worth of property. Again, it doesn't matter. As long as it's 3 properties or less, they can be any purchase price, any amount. We could be buying each one of them for $10 million a piece, all right, for a total of $30 million in identification. Doesn't matter as long as it's 3 properties or less, all right? It does not matter on the purchase prices. What does matter? And I'll say it again, guys. If you identify 3 properties, boy, you better make sure you're going to be able to buy at least one of them. All right, so what's the best way to lock up a property? To put one of them under contract. Now, you're not required to put it under contract, but that's typically what we see, is somebody will put a property under contract. That's one of the properties that they identify. And then, I don't know, maybe they'll identify 2 other properties just as backups, because after midnight of the 45th day, if the property that they do have under contract, if something happens with that contract and the whole thing falls apart, at least they have the opportunity to purchase those 2 other properties that they would have identified. All right, so that's the 3 property rule. Now, here's the 200% rule. Again, this is where you exceed the 3 property rule, but that you cannot exceed 200% or 2 times the combined fair market value of the property being sold. All right, so here's how it works. Again, we sell for $1 million. Now, this time we go out and we identify 5 properties, okay? Because we've identified 5 properties, what just happened? Well, it took us out of the 3% rule, all right? The 3 property rule, and it puts us into the 200% rule because we've identified 5 properties. So what does that mean? Well, what that means is the combined purchase prices of all 5 of those properties cannot exceed $2 million. Now, you may be asking yourself, well, where is he getting the $2 million from? We sold for $1 million, right? So 200% of $1 million that we sold, or 2 times the $1 million that we sold, is how much? $2 million, all right? So that's where it comes into play. All right, so this, hopefully everybody gets this one. This one's pretty straightforward. All right, now, here's the 95% rule. All right, again, this is where you exceed the 3 property rule, you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. All right, so here's how it works, guys. Again, we sell for $1 million. Let's say this time we go out, we identify 10 properties, all right? Because we've identified 10, what happens? Took us out of the three property rule, right? We've exceeded it, all right? Now, let's just keep the numbers simple. Let's say we're going to be buying each one of these properties for $1 million each, all right? So we've identified how much in property? $10 million worth of property, right? By identifying $10 million worth of property, what just happened? Well, we exceeded the 200% rule because that was how much? $2 million, right? So in our example, if we only acquire 9 out of the 10 properties, that's only 90% or $9 million. That's not 95%, right? If we do that, if we only acquire 9 out of the 10 properties, guess what happens? We blow our entire exchange and we have to pay all of the taxes, right? So the reality of the 95% rule is really 100% of whatever you've identified, you're going to have to buy, right? We're using really simple numbers. We're saying, hey, everything's going to be an even $1 million. You know, those purchase prices, they're going to be all over the map, right? It's going to be really, really hard to sit down and say, okay, let's see. If I get this property, wait, gosh, that's only going to put me at 93%. Well, maybe I need to make sure I purchase this other property. Wait, that's only going to put me at 94%, all right? Again, the 95% rule, the reality of the way it works is really 100%, all right? The IRS wants to limit you in how many properties you can identify. All right, they don't want you going out there identifying everything under the sun, because you know what's going to happen? If you identify everything under the sun, you're going to have to buy everything under the sun because of this crazy 95% rule. All right, so hopefully everybody gets this. If not, we can talk offline. You know, maybe we can go through some other examples. All right, now, how does the whole closing process work with 1031 exchange? Well, you know, we really don't start doing our thing until a contract gets signed on the property being sold, all right, the relinquished property, because the way the process works is I need to get a copy of that contract, right? I'll need to also get the contact information for the seller, and also I need to also get the contact information for whichever going to be handling the closing. Because what happens is on our end, we're going to reach out to that company who's handling the escrow, title company, attorney, all right? And what we're going to get from them is a copy of the title search, the title commitment, right? Once we get those documents in, then what happens is we go ahead and we prepare what we refer to as an exchange agreement, right? And those are basically documents that are going to set the exchange up, all right? They're going to be signed at the closing of the relinquished property, all right? At that closing, we're going to step into the shoes of the seller, all right? And that's the way we're able to take those proceeds from the sale, and whoever's going to be handling the closing, they're going to wire those proceeds over to us, and we're going to hold them on behalf of the seller, the exchanger, all right? So that transaction happens. The sale transaction happens. Then the clock starts ticking, right? 180 days to close. The first 45 days is the identification period. We're going to be sending out that identification ID letter. Client's going to complete it, sign off on it, get it back to us by midnight of the 45th day, right? Now, once they get a contract for their replacement property, we're going to need to get a copy of that as well. We're also going to need to find out who's going to be handling that closing, right? Because if you think about it, hey, we're holding all the proceeds from the sale, right? Typically, it's going to be a different company that's going to be handling the transaction for the purchase, right? We need a contact person. We need their wiring instructions, all that type of stuff, right? We're going to prepare some other documents that are going to be signed at the purchase of the replacement property, right? In that transaction, we're going to step into the shoes of the buyer. And that's the way we're able to take the proceeds from their sale, and we're going to wire those proceeds over to whoever's going to be handling the closing to help them purchase their replacement property, all right? That's it. That's the entire process. It's not that hard of a process as far as the closing goes. Just everything leading up to it is the complicated stuff, right? Trying to figure out what you want to purchase. Figuring it out by midnight of the 45th day, making sure you're closing by day 180, all right? Do you need to provide financing? You need to get a loan? You want to add cash? All that type of stuff is the complicated stuff. When it actually comes to the actual parts of the closing, that's the easier part of 1031 exchange. All right. Now, what are our fees? What do we charge for our services? Well, everything we talked about today, the most common type of exchange that we do, I don't know, 90 to 95% of all the exchanges we do are referred to as a delayed exchange. All right. And that's everything we talked about today. That's where you sell first. So you're selling your relinquished property first, right? You're identifying by midnight of the 45th day, and you're purchasing your replacement property last. You're purchasing your replacement property by day 180, all right? Again, that's referred to as a delayed exchange. Well, we charge $750 on the sale, right? Now, we don't collect anything until it physically closes, all right? I just walked y'all through the process. We like to start doing our thing once the contract gets signed. If we prepare the exchange agreement, it's sitting at the title company, escrow company, attorney's office, waiting for the closing to happen. If for some reason the transaction never closes, the contract falls apart, whatever it may be, okay, we don't charge any kind of cancellation fees, all right? We don't charge any type of wiring fees, anything like that. Our $750 is charged on the day it closes, all right? If you're a realtor, very similar to how you get paid, right? You don't earn your commission until it closes. Well, we don't earn our $750 until it physically closes. Now, once the transaction happens where they purchase their replacement property, we charge $250, not until that closes as well. All right. So if you sell one property, you buy one property, our total fee is $1,000. That's it. There's no other hidden fees, no other hidden costs, anything like that. All right. If for some reason you buy a second property, right, the second closing, second company we're dealing with, it's an additional. There's another seller involved. It's an additional $250. But typically, it's selling one, buying one. Our total fee is $1,000. Now, there's a few other type of exchanges. All right. We don't have time to go into them today. I do have a class coming up on the 21st, which is next Thursday. It's an advanced class, right? It's going to be from 11 to 12:15 Eastern time. We're going to talk about reverse exchanges, right? There's another type of exchange referred to as a construction and improvement exchange, right? Reverse exchanges work just the opposite of a delayed. It's actually where you buy your replacement property first and you sell your relinquished property last, all right? And in a construction exchange, you actually sell your relinquished property, but you find a property that you want to do some improvements to it, well, you can do a thing called a construction or improvement exchange. We're going to talk about those in more details in that advanced class next week. All right. That's Thursday the 21st from 11 to 12:15 Eastern time. But our fees for those start off at about $6,500, okay, for both types. They can be extremely complicated. We're forming a separate company. We're going on title. All right. I'm going to walk you through that entire process next week. All right. Also, in that class, we're going to talk more about numbers. I'm going to walk you through how to calculate what taxes are, how to calculate the taxes. We're going to talk about entities, LLCs, tenants in common, how they handle 1031 exchanges. All right. So if y'all are interested in coming to attending that class, please RSVP for it. We're going to talk, we'll cover some of the basics again, but it's going to be more advanced stuff. All right. All right. So that's it, guys. We're doing great on time. We have a few minutes left. I'll go ahead and open the floor up to questions. All right, so if you have any questions, again, there's a box on the right-hand side. Please feel free to type your question in right now. While we're waiting for questions to come in, I'll mention this to everybody again. Today's presentation was recorded, so you're going to receive a link to the recording of today's presentation if you want to refer back. And again, a lot of the topics that we covered, I have in PDF form. I'm going to email those out to y'all, all right? Again, it would be something great if you want to refer to any of the information later, or if you have a client, you want to forward it on to them. That would be great as well. What some people do is they have clients that have 1031 exchange needs. They'll forward that email on to them, pick and choose what PDFs they want to include with it. They may even CC me on the email introducing me to their client, all right? Don't feel like you have to be a 1031 exchange expert by any means, all right? I talk to people about 1031 exchange all day long, all right? I'll be glad to talk to your clients about 1031 exchanges, or you as an individual. If you're an individual investor yourself, I'd be glad to talk to you at any point in the process. Sometimes people just talk to me, call me and say, hey, I'm thinking about listing my property. thinking about doing a 1031 exchange. What are my options? All right. So at any point, I can talk to them. All right, let's see what questions we got coming in. Deborah, with the market being so competitive, what if you identify the 3 properties but are unable to secure one property through contract? Yeah, well, if you identify 3 properties on that form, okay, and it's after midnight of the 45th day, if you're unable to purchase any of those properties, get them under contract, unfortunately, there's no going back. Okay, if what we tell people is like, look, you don't start looking for property from when you close. You really need to start looking once you sign a contract, right? Because at that point you have a closing date, right? What some people do is, they'll make offers on properties even before they close on their relinquished property. They'll do it as a contingency type of offer. Contingent being what? Well, they got to sell their relinquished property first. Okay, now the reverse exchange might be a route that people could go. All right, especially in today's market, I totally understand people saying, gosh, it's so hard to find property. It's great when you're selling, right? Because, hey, I sold my property in a few days, but now I got to turn around and I have to find a replacement property. All right, reverse exchanges might be a good option if the numbers work for them. And what I tell some people too is like, I might get a call today and they may say, well, Jeff, I'm closing in 2 weeks. I don't know if I'm going to be able to find that perfect property. And I'll tell them, I say, look, if you close and then you call me and you want to do a 1031 exchange, it's going to be too late. All right. We charge $750 on the sale. And I'll say, look, if we set it all up for you, we're going to charge you $750 a day of closing, but at least it's going to buy you another 45 days to keep looking, to try to get everything figured out. And hey, if you don't find that perfect property, if you don't identify any properties by midnight of the 45th day, you're going to be paying all your taxes. The only thing that would be out of, at least from us, is $750. And the $750 in the whole scheme of things, if the client is sitting there thinking, having to look at a huge tax bill. I mean, the tax bills might be, let's say they're looking at $30,000 in taxes if they don't do a 1031 exchange. Well, to pay $750, give themselves another 45 days to try to get it all figured out. Hey, if they don't find the perfect replacement property, they don't identify anything, it only costs them $750. Was it worth their while to do it? Probably, because hey, if they do find that perfect property, if they are able to identify a property, close on it by day 180, they save the $30,000. But if not, hey, it only costs them $750. So again, if they close, they lose their ability to do a 1031. So we have to get involved prior to closing. All right. And let's see, Lori got a question. Can you identify one property on day 15 and another on day 30, or have to do all of them at one time? Yeah, you don't have to do anything. You don't have to identify any properties until midnight of the 45th day, right? You can do all the negotiating you want, figuring out what you want to buy. You don't have to do anything to us until midnight of the 45th day. If you choose to identify a property on day 15, no problem. If for some reason you're unable to purchase that property or get it under contract, you want to unidentify it, no problem at all. Unidentify it up until midnight of the 45th day. What we typically see is people don't send us anything until the very last minute. There's no reason to send us anything early unless they have it under contract, and if they close before midnight of the 45th day, we don't even get an identification letter. They close and their exchange is completed. That's it. Okay, hopefully that answers your question, Lori. All right. Okay, good. You're welcome. And, if anybody has questions after we hang up today, hey, shoot me an email, give me a call. I have my contact information up on the screen. I know sometimes it's hard to type in a question in 30 seconds or whatever. And if it's something really more complicated, typing it in, we can talk on the phone, or if you want to send me an email, I'd be glad to talk to any of y'all after today's class. All right, I think that's just about it. 11:59, so we're right on schedule. All right, well, I will go ahead and wrap it up. And again, like I said, if you have any other questions, just feel free to shoot me an email, give me a call. But I appreciate everybody hanging in there today with me. Hopefully you got something out of today's class. The email with the link will be coming out in the next few days. It has to upload and do some other things in the back end. I'll get those emails out to you guys too. But again, don't feel like you have to be an expert on 1031 exchange. I'd love to talk to your clients. I want to be a resource for you. And you know, if you're an investor, I want to be a resource for you as well. But thanks, guys. If y'all want to attend next week's class, again, it's on Thursday, the 21st. It's an advanced class from 11 to 12:15 Eastern. I do have a class after that the following week on the 28th, which is the following Thursday. That's called Discovering 1031 Exchanges. It's a 2-hour class. It's the basis class, today's class, and it advanced the next week's class, and even then some. All right. It's actually a 2-hour class. I teach it as a live event here in Florida for Florida realtors to get CE. I can't teach it as a live event, as a webinar anymore for CE. Still working on trying to get it converted over. But if y'all want to attend that, feel free. If you need the registration information, shoot me an email. All right. Thanks for attending. Everybody stay safe, stay healthy, and hopefully we'll talk in the future. Thank you. Bye-bye.